Good afternoon, everyone. Welcome back. This week, we'll start our final unit on government and politics and how these two topics can affect investing. So we'll be looking into some interesting and really complex ideas in the next 2 weeks. So in fact, there's actually a lot of debate among economists and academics about the role that government plays in the economy and the financial sector and whether it's helpful or counterproductive. So I'll try to touch on each of these topics as thoroughly as possible while trying to keep the information understanding and interesting. So just a quick reintroduction before we start. I'm Ryan. My team and I have set out on a mission to sort of spread the importance of understanding economics, finance, and business for real world applications. And as we get towards the end of the program, just start thinking about what you've learned and some useful ideas that you can take away from this class. So today we will start diving into the world of financial regulation and government intervention within the financial sector. So that means we'll be revisiting a lot of the Wall Street and banking entities that we covered in the last unit, and I'll do a quick refresher of that until just so that we'll all be on the same page. So during week 4, we took a tour around Wall Street. We first talked about how the term Wall Street serves two meanings. It can refer to the actual geographic location in New York City, which is home to major financial entities like the New York Stock Exchange, hedge funds, investment banks, and brokerages. And it can also mean the umbrella term for describing the overall global finance and investment community. So then we talked about the various financial entities that you can find on Wall Street and in major financial hubs around the world. You first have stock exchanges. These serve as marketplaces where buyers and sellers can trade stocks. Then we talked about hedge funds, which are another type of financial entity in the financial sector. These entities are investment firms that are designed to mitigate losses and risks with pooled money. And these entities try to deliver positive returns at all times. And then finally, we have brokerage companies that serve as middlemen that connect buyers and sellers in the stock market. So if you want to buy or sell a stock, you can't place an order through the stock exchange directly. Instead, you have to place your stock trade through a stock brokerage who then deals with the exchange on your behalf. And then last week, we looked into a major part of the financial sector, the banking industry. So there are a total of 8 different types of banks, but we looked at three out of the 4 most important ones. Retail banks provide services for individuals, like opening checking and savings accounts, issuing personal loans and mortgages, and offering credit and debit cards. This is the type of bank that you usually picture when thinking of the word, bank. And then you have commercial banks, which are more geared towards serving businesses, and they often offer services like managing business accounts and issuing business loans. And then finally, we talked about investment banks, which serve as these financial intermediaries. They perform a variety of many activities, mainly serving to manage large and complex financial transactions like IPO underwriting and facilitating mergers and acquisitions. And then the 4th important bank type I want to go over is the central bank, and I'll be talking about that more today. And then we also talked about the sheer size of the banking industry, and we gave a general description of how they kind of operate. So Rukmini last time, when she was discussing the banking industry, she mentioned how banks were subject to financial regulation. And we'll be exploring the idea of government regulation more in depth today. So then we briefly went over balance sheets, and this topic is really important to understand if you want to go into investment and finance, but it's not a priority to completely lock down. So then finally, we discussed the fractional reserve system. So this type of banking system makes sure that banks keep a fraction of their deposits at hand and allows them to use the rest for any other purposes, such as investing in assets or issuing loans. So if you remember the diagram from last week, this system basically gives banks influence over the money supply. It allows them to create and destroy money. And the one thing that regulates the fractional reserve system is the reserve ratio, and which restricts the percentage of deposits that a bank is able to lend out. And this ratio is set by the central bank. So with Unit 2 complete, let's start with our unit, and we'll start talking about government and politics. So when we're talking about government and politics and how they may influence the financial and investing world, we're really talking about public finance. So public finance is the study of the role of government in the economy. And as investors, we have to understand public finance and keep up to date with what the government is doing in terms of economic and financial policy. So changes in policy alter the rules of the game that companies sort of operate by. So companies' performances will change as well. Public finance is said to have 3 objectives. Usually when governments try to enact economic and financial policy, they're attempting to address one or more of these three objectives. So the first objective is to ensure the efficient allocation of available resources. This is a fairly simple concept that you'll get familiar with once you start learning economics. So in essence, there are limited resources and unlimited wants. So this creates a problem called scarcity. And because there is scarcity, we as a society have to ensure that resources are being allocated or distributed to places where they are most needed. And one thing that you'll take away from a basic economics course is that markets are usually efficient and effective in efficiently allocating resources. So unfortunately, there are times when markets are inefficient. Then it becomes the government's job to kind of step in and correct these market failures. And the second objective of public finance is keeping track of the distribution of income among citizens. So income inequality is a fairly large issue in countries all over the world. Historically, too much income inequality has led to civil unrest and rebellion. So it's in the government's self-interest to try to mitigate this income inequality as much as possible. And this can be done through a variety of different methods. And we'll be going over some today as we look at historical examples. And then the third and final objective of public finance is maintaining the stability of the economy. So the economy is very difficult to quantify and analyze. So economists use a variety of different benchmarks to measure the health and stability of the economy. So these benchmarks include GDP, which is gross domestic product, the unemployment rate, the inflation rate, marginal propensity to consume, and all that stuff. So using these economic indicators, the government gets a sense of what state the economy is in and uses a few tools at its disposal to maintain stability. And we'll look at some of those tools today, but we'll cover the two major tools that they use next week, which are fiscal and monetary policy. So enacting financial regulation is an important aspect in public finance. One thing that you have to understand is the process of enacting regulation. So this means learning the structure of government and which specific entities deal with what. So in the United States, there are three major entities that deal with public finance and financial regulation. The Federal Reserve is a major player in government financial regulation. It's a central bank, which is a specialized type of bank that mainly focuses on maintaining economic stability within the country. Most industrialized countries with complex economies need a central bank to ensure economic and financial stability. And the Federal Reserve System within the United States is fairly independent from the government. The reason why this is the case is because it's a good idea to separate public finance from politics. Public finance is all about big picture and planning for the long term, whereas politics is all flashy, fairly corruptible, and strives for immediate results. So therefore, the Federal Reserve is separate from the major three branches of government to avoid conflicts of interest. And the Fed's three functions are conducting monetary policy, something we'll discuss next week, providing effective and efficient payment systems, and most importantly, for our purposes, supervising and regulating banking operations. So the two other major public finance regulators in the United States are the legislative and executive branch. So the legislative branch, as most of you guys probably already know, it is given the role of writing and passing laws. So Congress has the power to pass laws regarding economic and financial policy when they see fit. And one particular aspect of congressional regulation is that these laws are usually very broad and vague because senators and representatives typically aren't economic or financial experts, so they don't know the specifics of how to enact the laws they pass. This job is usually given to the executive office of the executive branch. So when you ask most people, like, well, what do they think of the executive branch? They usually say the president, the vice president, the cabinet, etc. However, that's only the tip of the iceberg. The executive branch is also home to the executive office of the president, the EOP, which is like a group of advisors and specialized agencies, as well as various cabinet and non-cabinet departments filled with experts, bureaucrats that are specialized in their fields of work. So three examples of important executive branch entities that are geared towards dealing with economic and financial policy are the Department of the Treasury, the Department of Labor, and the Securities and Exchange Commission. So these are there are plenty of other departments and agencies that serve in public finance and financial regulation, but these are the three that I think that you guys should be familiar with. So to get a better understanding of how financial regulation and public finance in general works, let's take a look at a few historical examples of times when economic and financial policy were in dire need and especially used. So each of these examples occurred in different eras with different economic principles and political ideologies, and they all provide, fascinating case studies for further research. So the first one, the Great Depression, is regarded as one of the first modern financial crises, besides this other like South Sea bubble in 1720 in England. So lasting around 10 years, it remains the longest and perhaps most severe economic downturn in modern history. This event played a significant role in American and global economics and had a major influence on politics and economic theory. So the question is, what really happened? Well, there are three major causes of the economic crisis that most scholars agree on. The stock market crash of 1929 is a well-known reason. The crash was a major market correction that came after years of rising stock prices. So during the Roaring '20s, people were feeling really good financially and started pouring a lot of money into the stock market as an easy way to make money. A lot of people even borrowed money for specific reasons, for the specific reason of buying stocks. At this point, market prices were way higher than the intrinsic values of the underlying prices. And if you remember the theory behind value investing, then you will recognize that this is a dangerous position to be in and just close out all long-term positions. So when the prices did correct, it was too late. So the result was a profound psychological shock and loss of confidence in the economy for both businesses and consumers. And then the second attributed cause is banking panics. So at this time, deposits in the bank were not insured by the government, meaning that if the bank mismanages their finances, your money could just straight up disappear. So if you remember when we discussed the fractional reserve system, banks are able to lend out a large fraction of deposits from clients. If a ton of clients were to suddenly return and demand their money back, the bank is not going to be able to give it all back. So these banking panics were a serious issue leading up to and during the Great Depression. Ironically, the frequent effect of a banking panic is to bring the very crisis that panicked customers aim to protect themselves against. So this means that even the slightest rumor that a financially healthy bank was having solvency issues could cause its collapse. So the natural consequence of these widespread bank failures was a decrease of consumer spending and business investments, which of course led to a decline in economic activity. And then the third and final widely considered cause of the Great Depression involves international economics. So in the late 1920s, the United States engaged in decreased international lending and increased tariffs, which are basically taxes on imports. These practices were mainly enacted to protect US producers. For example, American agricultural interests were suffering due to overproduction and increased competition from Europe. So they lobbied Congress for the passage of these new tariffs on agricultural imports. And then Congress eventually adopted broad legislation that imposed all these steep tariffs on wide ranges of agricultural and industrial products. And policy changes like these changed the rules of the game for businesses. So one could argue that investing in American agriculture while these tariffs were passed would have been the move. However, these major tariffs also caused America's international trading partners to retaliate by raising prices on US-made goods. So the result was shrinking international trade and an even further decline in national economies around the world. So the combination of these three factors and other possible ones led to the perfect storm culminating in the Great Depression. As the effects of the Depression cascaded across the US economy, millions of people lost their jobs. By 1930, there were 4.3 million unemployed, and by 1931, 8 million, and then in 1932, the number had risen to around 12 million. And by early 1933, almost 13 million were out of work, and the unemployment rate stood at around an astonishing 25%. So those who managed to retain their jobs often had to take pay cuts of a third or more. So out-of-work Americans filled long bread lines, as you see here. They begged for food or sold apples on street corners. More than a third of the nation's banks failed in the 3 years following 1929, and long lines of desperate and despairing people outside banks hoping to retrieve their life savings were common. And many ordinary citizens lost their life savings when banks failed. It was very unfortunate. And then this was also a time when public finance was vital to revamping the economy. So Herbert Hoover, the president at the time, stuck to his traditional Republican beliefs of limited government interference. So in his defense, at this point in economic theory, classical economics dictated that the markets would correct themselves with minimal government interference. But by the time Hoover sort of retracted his earlier approach and started to look towards public finance, it was too late, and he was quickly voted out of office in a landslide. So then his successor, Franklin Delano Roosevelt, championed a series of federal legislative initiatives known as the New Deal. And these initiatives were often summed up by the three R's: relief for the unemployed, recovery of the economy through federal spending and job creation, and reform of capitalism by means of regulatory legislation and creation of new social welfare programs. And the last R regarding reform is all about financial regulation. So the most influential regulatory legislation that came about during the New Deal was the Glass-Steagall Act of 1933. This act separated investment banking from retail banking. So this meant that retail banks, the ones that you and I go to as individuals, were prohibited from using depositors' money for risky investments. And the law also granted the Federal Reserve more power on how they could conduct monetary policy. It also prohibited bank officials from borrowing excessively from their own bank. So all in all, the law was, landmark legislation in the world of finance and investing. And in addition, the FDIC, the Federal Deposit Insurance Corporation, was founded to provide deposit insurance so that you'll be able to get back the money that you deposited, even if your bank went solvent. So this largely solved the issue of banking panics. And then the issue that remains, of course, is did the New Deal and all these new regulations fix the aftermath and the issues that led to the Great Depression? Well, to be honest, we can't really say for sure. The science of economics is very difficult from the hard sciences of, say, like chemistry or physics. So experiments are hard to come by because the test subject is the entire economy. So we can't alter conditions without consequences or set control variables. And because of this, financial crises like the Great Depression are very difficult to solve. So then in history, and this is our second historical example. So in history classes, we often learn about wars, the ingenious plans, the inspiring stories, and the riveting battles are all very fun to learn about. What isn't as fun, but oftentimes even more important than the wars themselves, is what happens afterwards. So World War II left many parts of the world in ruins. First off, approximately 70 to 85 million people perished due to the war. So as you can imagine, the drop of around 3% of the world population was especially devastating for economies around the world. Soldiers who didn't return from the front lines, along with women and children killed in the crossfire, they were no longer able to return to the workforce or the educational system to revamp the economy. So secondly, the war left many parts of the world decimated. So as you can see here, the destruction of cities and villages across Europe and Asia took away many factors of production. The labor wasn't there because of the aforementioned casualties. To make matters worse, land and capital were burned and bombed beyond repair. And then, as you guys can see here, this is actually Berlin in destruction. This here, I believe, is Hiroshima after the atomic bomb. And then finally, we have the rise of the Soviet Union and its communist and totalitarian economic policies, which made the process of healing the wounds of World War II especially difficult, especially for Eastern European countries under Soviet Union influence. And these countries had a very difficult time during economic recovery as the regime's anti-capitalistic policies stunted economic growth. So with the ascension of the Soviet Union as a new global superpower, the United States realized that they needed to capitalize on economic recovery as much as possible. So firstly, the US enacted the Marshall Plan to help Europe recover and rebuild its economy. Also known as the European Recovery Program, the Marshall Plan was enacted in 1948 and provided more than $15 billion to help finance rebuilding efforts on the continent. So the plan involved reconstructing cities, in industries and infrastructure that were heavily damaged during the war, and to remove trade barriers between European neighbors, and as well to foster commerce between those countries and the United States. So as you can probably tell, one of the other stated goals of the Marshall Plan was to halt the spread of communism on the European continent by trying to reintroduce free market capitalism. And then another major event during post-war recovery was the Bretton Woods Agreement. So by 1944, countries started realizing that an Allied victory was certain, and at that point, people started to discuss what a post-World War II war would look like. So especially in terms in regard to international finance. So if you remember from this slide here, we talked about how, actually in the Great Depression, we talked about how decreased international trade played a huge factor in the Great Depression. So now they're just trying to make sure that this doesn't happen again. So Bretton Woods Agreement was created in a 1944 conference of all the World War II allied nations. It took place in Bretton Woods, New Hampshire, and under the agreement, countries promised that their central banks would maintain fixed exchange rates between their currencies and the dollar. So if a country's currency value became too weak relative to the dollar, the bank would buy up its currency in foreign exchange markets. Members of the Bretton Woods system agreed to avoid trade wars. For example, they wouldn't lower their currency strictly to increase trade. So this was all done just to make sure that everyone was friendly on the international market and that no one was causing any major trade wars. And this landmark international finance agreement was huge in creating a financially stable post-World War II world. All right, and then lastly, we have the Great Recession. So besides the COVID-19 pandemic, the Great Recession was the latest financial catastrophe in the United States history. So this was an event that actually happened it happened like in or very close to your lifetimes, I'm guessing. So the effect of this crisis is still very prominent. So even as we endure through the current pandemic, we're still living in the aftermath of the 2007-2009 financial crisis. So like the Great Depression, the causes and conditions that led to the financial crisis are still fairly controversial and widely debated among academics. There are a few possible reasons that most of us agree on. However, these reasons are fairly complex and require at least like an hour of explanation to fully understand them. So I'll just do my best to simplify them as much as possible. So the first reason is rising inequality. So relative poverty grew as the earnings of much of the middle class slowly drifted upwards, whereas the income of the top 20% skyrocketed. So people saw the living standards of those around them and seek to emulate them. So this meant that more and more people wanted to live out the American dream and buy homes. So in turn, housing prices grew at a steady rate. And because people didn't have all the money at hand to buy houses, they took out more and more mortgages, which are simply loans for houses. And then the second reason is the deregulation of bank lending. So the mortgage market system at this point made a series of really bad incentives that encouraged banks to issue as many mortgages as possible, even if it was likely for the borrower of those mortgages to never be able to repay the bank back. So this deregulation, paired with minimal oversight from the government, allowed banks to introduce new mortgage types that essentially targeted the financially unsophisticated, low-income households. So these mortgage types included no documentation loans, where you didn't have to state your income, ninja loans, which were for people with no jobs, no income, no assets, adjustable rate mortgages, which had really low teaser interest rates that would like kind of like draw you in, like, oh, like I'll pick this mortgage because it has really low interest rates. And then after like you've had that mortgage for a while, it suddenly jumps up. So then you would have these rapidly changing interest rates that would go up, and the list goes on. Basically, the banks engaged in some very risky lending practices when it came to issuing mortgages. Whether the banks were in on all of this or not is still up for debate. A lot of people believe that they were, but it's still actively debated among academics. So between these two reasons, along with many of others that I won't be able to go over, caused people to take out more and more mortgages. And people were happy that they were getting homes, but as time passed, they realized that the terms of their mortgages were less than ideal. So when you're unable to pay back your mortgage, you basically go into what's called default. The bank that you borrowed the mortgage from forecloses your house and takes it under its ownership. So that leaves you without a house. So this is what happened to many Americans that took out mortgages with bad loan terms. So if you can, I don't know if you guys should probably be able to see this. This graph shows the sudden jump in mortgage delinquencies that occurred from 2008 through 2010. Delinquencies are when you're behind your mortgage payments, but you haven't defaulted yet. So as you can see, there was this huge jump during the financial crisis that resulted in tons of delinquencies, which of course led to tons of defaults. And then this complete absolute meltdown of the mortgage market led to severe economic downturn that is reminiscent of the Great Depression. So as millions of people lost their jobs, their homes and savings, the poverty rate in America increased from 12.5% in 2007 to more than 50% in 2010. So as seen in the chart here, the unemployment rate also rose rapidly. So businesses were losing demand. They had to lay off workers to offset the losses. And these fired workers then had no money to buy products, so demand decreased even further. The recession saw the rise of two noteworthy political movements on opposite sides of the political spectrum. You had the Tea Party movement that arose in the aftermath of Obama's election into office in 2008. Supporters of the Tea Party took a stance against big government. They opposed taxes and government regulation on business. As the government started to provide aid to those affected by the recession, the Tea Party bashed these programs as government handouts to underserving people of society. One point that they continuously brought up was like, why should they have to pay when their neighbors defaulted on a bad loan? And then on the other side, you had the Occupy Wall Street movement. This started as a protest in September 2011, I believe, at Wall Street in New York City, before spreading to other cities. So participants gathered against social and economic inequality, greed, corruption, and the undue influence of corporations, and particularly the financial sector, on government. So does it sound familiar? Key aspects of the Occupy Wall Street movement live on today, especially with the left-leaning side of the Democratic Party. And one person that comes to mind that has been championing these ideas for decades now is Bernie Sanders. His widespread support in the last decade has shown that people still resonate with the ideas of the Occupy Wall Street movement. So due to the complexity of the financial crisis, the government had a hard time enacting public finance policies to combat it. So the response was similar to following the Great Depression. However, Presidents George W. Bush and Barack Obama signed into law several major legislative responses to the financial crisis of 2008. And these were kind of like three major ones. So the most influential and controversial of these was the Dodd-Frank Wall Street Reform and Consumer Protection Act, which this one introduced a raft of measures designated to regulate the activities of the financial sector and protect consumers. So the act itself was both significant in terms of financial regulation and in its complexity. Reading through it, I can barely understand it myself, and I think it's safe to bet that most senators and representatives don't really understand it either. It's just like there's so many titles, there's so many different laws like within it, and like it creates a lot of agencies with a lot of different roles. It's a complete mess. Another notable law was the Emergency Economic Stabilization Act, which created the Troubled Asset Relief Program. This was basically the bank bailout. They had to bail out the banks that were too big to fail. This actually made a lot of people angry, especially I believe within the Tea Party and the Occupy Wall Street movement. They thought that this was all a waste of money and that the banks were being bailed out and it was all like an inside job. But that's up for debate once again. And then moreover, the Federal Reserve actually took up many new additional measures of its own. And then finally, you have the American Recovery and Reinvestment Act. This was basically the stimulus package that Barack Obama passed to try to stimulate the economy, inject money back into the economy to try to revamp it. And I would say it's fairly successful. However, we're still recovering from the Great Recession, and there's obviously there's still a lot of political resonance when it comes to what happened to a lot of people during the Great Recession. So that's kind of what you see in politics today. So that's all I have for today. We have a Kahoot. Unfortunately, we don't have a guest speaker. As we're trying to wind down, we're trying to save some time. I know you guys are starting to get busy again with the school year, so we'll just do this Kahoot, and then we'll finish up. started, and you guys can continue to join in as we go. All right, question 1. What is public finance? All right, a huge divide here. So yeah, public finance is the study of the role of government in the economy. So it's not the study of publicly owned corporations, unfortunately, because publicly owned corporations, as you know, are the ones that issue stock. They're publicly traded, like for example, like Amazon, Apple, all that stuff. So that's not what public finance is about. Public finance is about. It's all about government and how it interacts with the economy. Question 2. Which of these is not an objective of public finance? Whoa, all right. So the maximization of, all right, I spelled that wrong, but the maximization of GDP is not an objective of public finance. Just because you have a high GDP doesn't mean that your economy is doing well. Public finance is all about trying to efficiently allocate resources, trying to keep the economy stable, and trying to distribute, trying to keep income equality as trying to suppress income inequality as much as possible. All right, question 3. What type of bank is the Federal Reserve? Right, yeah, so the Federal Reserve, as most guys got, is a central bank. Yeah. All right, true or false? The Federal Reserve is independent from the government. Oh, yeah, this one is true. So, does anyone know why it's independent from the government? Right, basically, it's independent from the government because there's always a potential for conflict of interest between like politics and good economic policy. So economics, public finance is all about trying to secure long-term growth, trying to make sure that things are stable, and politics is all about it's all about being flashy. It's easily corruptible, and it's all about showing immediate results. So that's why the Federal Reserve is independent from the government, so that it doesn't get politics doesn't interfere with it. All right, question 5. Congress has what role? So Congress has the role of writing and passing laws. Conducting monetary policy, that is the role of the Federal Reserve. Executing the law, that's, of course, the role of the executive branch. And reviewing laws and deciding their meaning application is the role of the judiciary branch. Question 6. Which of the following financial regulators is under the executive branch? most of you guys got this one. It is the Securities and Exchange, Securities and Exchange Commission. Yeah, definitely. I did not spell that one right either. So it's not the Senate. Of course, the Senate's part of the Congress. The Department of Homeland Security is part of the executive branch, but it's not a financial regulator. And the Federal Reserve, as you know, is independent from the government. Question 7. The Great Depression occurred in what period? Good. So yeah, the Great Depression occurred around between 1929 through 1939. It really started to fade out as World War II started. So there's that. All right. Question 8. Which of these is a likely cause of the Great Depression? Very good. Yeah, bank failures was a major cause of the Great Depression. All these other ones don't make sense at the time, or they just had nothing to do with it, like prohibition. Question 9. Which country was divided in two following the Second World War? And most of you guys got this one. Germany was in fact divided into two parts following the Second World War. The west side was controlled by the Allied powers. The Western powers really, and the east side was controlled by the Soviet Union. All right, question 10. Which piece of legislation helped provide financial aid to Europe following World War II? Yeah, the Marshall Plan was the piece of legislation that helped provide financial aid to Europe following World War II, and also had the goal of, of course, trying to halt communism, to try to stop the spread of communism within Europe by introducing capitalism and free markets. All right, true or false? The Bretton Woods Agreement sought to ease international financial markets after World War II. All right, this is true. Yeah, basically a bunch of allied countries met. They basically said that one of the major causes of the Great Depression was that there was major tension in the international economy regarding increased tariffs. So this is all done basically to try to establish partnerships again, to try to reestablish international financial markets. All right, question 12. Why did rising inequality help cause the Great Recession? Well, all right, so yeah, more people took out mortgages to try to live out the American dream, because as the country got more divided, as like people were seeing like the upper middle class and the upper class living out, really, really nice lives. So relative poverty, excuse me, was, a major thing in the American psyche, so that more people took out mortgages because they wanted to live like the upper middle class and the upper class. So that's kind of the reason. All right, question 13. Bernie Sanders supporters are likely to come from which movement following the Great Recession? All right, yeah, this one was pretty easy. Yeah, Bernie Sanders supporters, I bet that a lot of them come from Occupy Wall Street, because his ideology really reflects that of the Occupy Wall Street movement. Right, question 14, true or false? The Dodd-Frank Act was known to be a bailout for the big banks. All right, so this is actually false. The Dodd-Frank Act was major. If you guys can see here, let's see. Yeah, the Dodd-Frank Act was all about Wall Street reform and consumer protection. The bank bailout was the Emergency Economic Stabilization Act. Dodd-Frank was, that huge complex financial legislation that tried to basically uh, encourage financial regulation. Basically, the goal was to make sure that something like the Great Recession would never happen again. All right, final question. Which event caused the greatest spike in unemployment in US history? Well, all right. So only one of you got it. I'm not too sure who it is, but yes, the COVID-19 pandemic was, in fact, caused the greatest spike in unemployment in U.S. history. If I look up, if I go here and I search up unemployment data, you'll see that things were pretty bad. Well, they don't have data in 1930, but basically, it got really bad here. So this was actually, the coronavirus pandemic was actually the largest spike in unemployment in US history. So we're living in history, basically. All right, congratulations to Anna, Adam, and Em, and Jessica, and Eva. Nice playing, guys. So let's see. Yeah, let's see the stock market game. These are the people who did really well this week. As we start to wrap up the program, see what you can do. You can start your own games. Basically, the game's not going to stop. So if you want to continue trading, be my guest. If you want to see if if you're good at this, and if you think that you can actually make some money out of it, then try to get your parents to open a brokerage account. But that's all I have for you, and have a great weekend, guys.